Okay, guys, so we're going to start with, do you see right now how you can see the green at the bottom? And you see how the blue is on right here? Okay, so if you see all of a sudden that become red, will you just stop me and say, hey, it's not working? It's not your job, but that would be helpful for me. Okay, so guys, we are going to start with the PowerPoint for Chapter 1. Now, how many of you guys have been in, how many of you guys have been in a business and been aware of the transactions that can happen in a business? So we're going to really go into detail from the start of various financial transactions and how we record them and communicate that information to users. So basically, the first thing we're going to talk about, and this might be a review for you, but we're going to talk about different types of businesses. There are primarily various organizational structures or forms that businesses can operate in. The simplest and easiest, and actually the largest number of businesses, conduct themselves as what's called a sole proprietorship. This is where a single individual one day wakes up and says, I'm going into business today. So they are on their own. The ease of formation is fairly simple. And they basically conduct the business. They have to raise their own money, and they own it, and they control the business. Another type of business that we're not seeing as much of anymore because we're taking on different legal entity forms, but a partnership is where two people come together. Aaron and Clark come together and go, hey, you do this well, I do this part well, let's form a business. So two people just verbally, or they can written. The scary part about a partnership is you might be in a partnership and you don't even know it, and you can be held liable. But the two of you somehow decide you're going to go into business together, and you join forces, join minds, you share the income, you share the losses. It's a business. The most common form we know of, that we hear of, are corporations. Now, even though sole proprietorships make up about 80% of the businesses in the United States, corporations control, or their revenues are probably 80 to 90% of the business in the United States. Corporations are nice because with a corporation, the ownership of the corporation is generally separated from people who run the corporation. They are, the structure's more complex, but the beauty of this relates to limited liability. In the situation of sole proprietorships and partnerships, you get all the benefits, but you also have to eat the losses. With a corporation, you invest in shares of a company, and the only amount you can lose is that portion you have invested in the company. So and that's another thing. If I talk about it in class, you might see it again. If I don't bring it up in class, you won't see it again. Okay? Know that the negative with sole proprietorships and partnerships is called unlimited liability. Clark can be held accountable for some of Aaron's actions related to the business. That can be scary. Same with a sole proprietor. So if someone wants to sue me, they not only can necessarily come after my business assets, but they could come after my personal assets. Whereas within a corporation, you can only lose that which you've invested. Absolutely. And I was going to say, nowadays we don't see partnerships anymore. We generally see what's called a limited liability company, which also then gives you that benefit of limiting your liability. In this litigious society where everyone's out to make a buck on someone else's, negative, you have to protect yourselves.
So I have a question, actually.
Sure.
Would an LP or an LLP then fall under corporation, or is that technically still a partnership?
It is a partnership, but it's considered a limited liability partnership where, depending on what type of partner you are, you have limited liability. For this purpose of testing, sole proprietorship and partnership, easy to establish, easy to get involved in, easy to dissolve. The benefits are yours, but the negative is yours. That unlimited liability is a negative. The other bummer with a sole proprietor or a partnership, you might have a great idea, but you have limited funds. When you get involved with corporations, it's easier to raise equity or capital because of the vast resources of people that can invest with you. Okay. In choosing the organizational form for your outdoor guide service, you should consider the pros and cons of each. Identify each of the following organizational characteristics with the organizational form or forms with which it is associated. So if we look here at a company that's easier to raise funds, what would we be talking about? Corporation. Simple to establish. Partners and souls. No personal legal liability. Tax advantages. Easier to transfer ownership. Corporation. Excuse me. The other thing with the corporation is when a shareholder dies, it doesn't terminate the corporation. When one of the partners in a partnership dies, the partnership is no longer. Same with the sole proprietor. So that ease of transferring ownership with the corporation allows it to continue on. Okay, so we got that right. Now, the whole purpose of this course is to understand how we go about collecting financial information, presenting it in the form of financial statements, to ultimately provide it for end users to use. This slide right here shows various kinds of people who have an interest in financial information. Internal users are those individuals within an organization, employees, directors, management, that take that information and use it for a specific purpose. Here, internal users, as this little example shows, what price should Apple charge for an iPod to maximize the company's net income? Well, the Apple marketing employee is going to check to find what will the market hold for an iPod. The latest Apple 6 phone is coming out. How many of you guys have looked into it at all? I don't know what the price is, but you know darn well Apple structures those pricing so they can get the maximum buck without turning away business. Management. Which PepsiCo product line is the most profitable? Should any product lines be eliminated? So management makes strategic goals and plans for how their company will best be profitable going forward. Finance. The finance department. Is cash sufficient to pay dividends to Microsoft stockholders? So you've got these owners who have invested their money in the form of and receive stock. And everybody, when they invest in products or goods or companies, wants some type of return. So a dividend is a form of return on your money. And it's important for companies to know, do we have the cash reserves available to pay a dividend back to the shareholders? These are reasons people use financial statements, they need to get this information in the form of financial statements. Human resources, can General Motors afford to give its employees pay raises this year? So internal users, which are mainly users within the organization, use that information for financial purposes in a different way than external users are going to use it. They're using that information to improve, to expand, to make decisions for within the business and the growth of the business. On the other hand, there are external users of financial information. External users are those individuals that are apart from the organization, be it banks, stockholders, a community. Here are some examples. Here's a creditor. Will United Airlines be able to pay its debts as they come due? So depending on how the financial positioning and condition of a company is, a bank's going to worry, am I going to get paid back my loan? Or do I even want to lend them money? Are they sustainable to where and safe to where I want to lend them money? Is that a good decision for us? Investors, how does Disney compare in size and profitability with Time Warner? So a lot of times investors have limited resources as to how they want to use their money. And so financial information is how we decide, do I want to invest in Disney? Do I want to invest in Target right now? Probably not. You know, and so we make those decisions based on financial information. If money was endless, we could invest in everything, but it's not the way it works. And then an investor in GE would wonder, do I want to keep my money here? Are they providing, doing well enough? So internal users within the company, external users outside the company. Anybody who has listened to the news in the past years knows that we as accounting, the accountants and CPAs as a society have really failed the public. It began with Enron and WorldCom back in the early 2000s when the largest accounting firm ended up shutting its doors as a result of unethical behavior. Yes, Enron and WorldCom were doing inappropriate and fraudulent actions, but the accountants were right in there with them, hiding it. So we have really taken a hit, and rightfully so, because we have not upheld to our standards of independence and professional care to protect the public's best interest. As a result of these huge scandals that happened in the early 2000s, Sarbanes-Oxley was created by Congress. And basically, we call it the SOX Acts, came in and provided new guidelines, new penalties, new guidelines as it involves auditing CPAs auditing public firms. They required much more of accountability and an understanding of internal controls. There was a lot of sweeping reform that passed. So why did that pass? It happened because of all the wrongdoing. Now, many of us thought that that would change ethical behavior. People are people are people. And unfortunately, since Sarbanes-Oxley, we continue to see the Madoffs, the Denny Heckers, the Petters. I mean, the list just is kind of sad. So as long as there are people, there will be people who have greed and try to cheat, lie, and steal. But our job as accountants is to regain the public's trust, but also make sure we have a responsibility to make sure that financial reporting the information we're providing on financial statements is accurate. We'll talk about that. We've taken a dive in the past years, know that, and we are trying to come out of the water. So ethics plays an important role in our position because ethics is about doing the right thing. What do you do when no one else is looking? What do you think about something? Ethics is, in most business classes, something you talk about because in this day and age, we have seen so much unethical behavior. We are trying to instruct the public and students along with employees that we need to create actions that are ethical and positive for the company, not always after our own pocket. Now, here's a review question let's look at. Which of the following did not result from the Sarbanes-Oxley Act? Top management must now certify the accuracy of financial information. Penalties for fraudulent activity increased. Independence of auditors increased. All those three, A, B, and C, have happened as a result of SOX. Which did not result from SOX? Tax rates on corporations increased. On the contrary, tax rates are the corporate taxes are the lowest they've been in the past 50 years in this current climate. Now, so we began by talking about forms of business organizations, sole proprietor, partnerships, corporations. We talked about in providing financial information, there are different uses for it. Internal users have a different need than external users. Now we're going to talk about various activities that businesses get involved in. Businesses deal with three primary types of activities: financing, investing, and operating. Financing activities are ways of getting money, getting resources. Financing activities may be acquiring capital, may be acquiring some type of bonds, debt. Investing are ways in which companies put money into their company to expand it. It might be in great equipment. It might be in buildings. It might be in land. Investing activities are those which promote the business. And then operating activities are why a business is in existence anyway. So for Shoemake CPA, my operating is providing services of tax work to clients. So the revenues and the expenses I incur with doing that service is my operating activity. If we're dealing with an auto repair shop, financing may be securing ways of banking, lines of credit in order to expand. Investing may be expanding or adding additions onto their building, or building another building, another location, or it could be investing in equipment. And then operating activities are the activities or revenues and expenses incurred with the business you're in. So in an auto shop, it would be getting those services, repairing those automobiles, and the costs associated with that. An accounting information system is basically the manner in which we gather all of our economic events and record them. But no, guys, there's three types of activities. Financing has to do with getting money, getting the resources. Investing has to do with what are you building? And then operating has to do with the day-to-day activities as to why you're in business. Augsburg's operating activities are to provide an education, okay? So the resources in providing that education is the operating activities of Augsburg. The financing may be through various bonds when they create another a building. They might take out some debt that they'll repay down the road. They might receive investments from benefactors or from alumni. And then investing, they just built this Oren Center, I don't know how long ago, but it's pretty awesome. That was investing in the business, expanding, improving. Any questions so far? You guys good? So when we're dealing with financing activities, we can borrow money, which is debt, or we can raise capital by selling, issuing, or giving shares of stock in exchange for money. Two ways of financing. When we borrow money, we call that liabilities. It is something now that will require a future sacrifice we're going to have to pay back. So we have a claim that we need to pay back down the road. We have to pay that back. We have to expend something down the road. That's a liability. When you owe someone money, they're called your creditors, aren't they? How many of you guys know that one? Most of us have a creditor here or there. Now, notes payable and bonds payable are different. A note payable generally is a promissory note, usually with a bank or an individual, where you promise to pay a certain amount back within a fixed period of time with interest. A bond is a greater long term where the bond holders have given you money in exchange for an investment that will be paid back over time. Generally dealt with for longer term and larger projects, and is generally paid back over a longer period of time than a note is. Now, when we have a stockholder, so Aaron gives me $5,000 for 5,000 shares in my new company, okay? He is a shareholder. He owns stock in the company. He's an owner in the company. And one of the ways that a shareholder or a stockholder gets rewarded from their investment is to receive dividends. So a dividend is basically a portion of the profits that go back to the people that invested in the company. Guys, am I going too fast, too slow, just right?
Perfect.
Okay.
Real quick.
Yes?
You go back.
Sure.
Good.
You bet.
Oh no, that's all I needed.
Okay. Okay, so financing activities are ways of receiving money. Investing activities are the purchasing of resources for a company to grow or to be created. This can be equipment. This can be buildings, land. We call computers, delivery trucks, furniture, buildings, all of those resources a company owns and controls that will ultimately provide a future benefit because it's going to last longer than today. We call those assets. Assets are resources companies own, that a company owns or controls. Investments are a form of an asset, okay? So investments are an asset, and investments also, in addition to just going and creating a building or purchasing a building or constructing a building, another way people use their cash, say they might have it short term, they might invest. They might invest in some of their cash in a short-term investment, or they may have cash and they might invest it in another business. So investments are a manner in which the type of activity investments fall under would be investing activities. So we can invest in buildings, equipment, land, other businesses, and other stock from other companies. Make sense? It's a way in which we take our, utilize our resources. Then operating activities is, why is the company in business to begin with? Brian's Automotive is in business for servicing automobiles. Shoemake CPA is in business for assisting clients in tax returns. The operating activities are why the company's in existence to begin with. The revenues that come in from these activities are those that either are earned because they sell products or services, or banks interest. Okay? Banks lend money. A result of their revenues would be interest coming in as a result of lending money. Inventory are those items that are available for customers to purchase. And then accounts receivable are when a sale has happened, but you have not received the money yet, but the sale actually took place. The accounts receivable is when we have a right to that money. That money will be coming to us soon. They just haven't paid us yet. So receivables are rights to receive monies from a customer as a result of a sale. Okay? So let's say, for example, that we are, Missa is creating kitchen cabinets for me. Okay? I gave her a $5,000 deposit on these cabinets, and Missa delivers the cabinets to me. I owe her an extra $4,000. I say to her, I don't have the cash right now, but I'll pay you in 40 days, 30 days. She has sold me a product. There has actually been a transaction where I now have received a product that she created. Okay? So accounts receivable for Missa would be the $4,000 I owe her. She earned that income and is just waiting for me to pay it. Any questions on what I'm trying to say here? Now, in a simple world, Missa builds a cabinet, she completes it, delivers it to my house, I write her a check for $9,000. It's a done deal. She's earned $9,000 in revenues, and then she would have costs in building those cabinets, but in exchange I give her cash. Many times in businesses we don't deal directly and pay right on time. So we record revenues when we actually earn them and expenses when we pay them, which I'll get into in a minute. In operating activities, we have expenses. Those are costs of assets consumed or used to provide the services we use. So for example, with the Shoemake CPA, I have rent I need to pay to be able to have people come in my office. I have telephone systems and internet services. I have programming where people have to come in and help correct or fix the computers. I have salaries of employees that help me do the taxes, answer the phone, greet the clients, work with the clients. I also will have some liabilities. So we just moved this past week. And prior to our move, we needed to bring an electrician in there to hook up a bunch of new circuits. So he completed the work. He gave me a bill. I haven't paid the bill yet. Right now, that's a liability. Expenses, liabilities arising from expenses include accounts payable, interest payable, wages payable, sales tax payable, and income taxes. That electric bill is an expense for me to do business. I haven't paid it yet. So it's a liability on my books. It's a claim I owe him that I need to pay in the very near future. Sometimes that happens with employees. An employee has worked a week, but the pay period isn't until the check won't be paid until next week. So once they have created the work, and we've incurred that expense of payroll, it's a liability until we pay them. Any questions on what I'm talking about here? Am I confusing anybody? You good? Revenues minus expenses give us net income. Now, if our revenues are less than our expenses, we have a net loss. You can't keep doing that for long and make it, right? So basically, all net income or net losses is the difference between the revenues we bring in and the expenses, okay? How you guys doing? Now let's look at a little exercise we're going to do. Classify each item as an asset, a liability, common stock, revenue, or expense. So I'm going to tell you again, assets are those resources we own that will provide us with a future benefit, which means this computer, Augsburg owns it. It's going to work today and it's going to work next year too. Do you see how it's going to provide us with continued benefit for a while? This building, this is a resource Augsburg owns that is going to last us for a lot of classrooms. A liability is something we owe somebody that we are going to have to sacrifice down the road, be it with money, with services, something we need to pay back. Okay, a liability. We get a loan at the bank. Do we get the loan because of our good looks? No, we get the loan because we're going to give them interest and we're going to pay them back the principal. Do you see how that's a sacrifice for us down the road? Common stock is the investment in the company, usually in the form of shares. Then revenues are earnings. Revenues are earnings from sales, from services, from, in Augsburg, tuition is a revenue for them. And expenses are those costs of providing business in the operating. An expense at Augsburg are our salaries. An expense at Augsburg are the utilities. An expense here would be tutors on hand to help students learn. Do you see what I'm saying? So let's look at these and see if we can figure out what's what. What would be the cost of renting property? It's an expense. Why? It's a cost. It gets used up. What about a truck purchased? It's an asset. But why isn't it like rent? Keep talking to me.
Could it be a liability also? It's not paid for.
Not yet. Just the truck. We don't care how it was financed, just the truck.
Well, the truck is yours, you purchased it.
It was a purchase, and it's going to last us more than just this month, isn't it? It's going to give us a future benefit, thank God. My automobiles last me, the latest one we bought in 2003, and it's 2014 with 230,000 miles on it. I've gotten my use out of it, haven't I? Notes payable. It's a liability. Okay, let's talk. The truck on one hand is the asset. The loan is the liability. Does that make sense? A liability is a claim that requires something you need to pay back. Okay? What is issuance of ownership shares? Stock. Or common stock, yeah. Amount earned from providing services. And amounts owed to suppliers. Liability. Owed is the key. Okay, guys, Does it make sense what I'm doing? Seriously, you're getting it. This is the toughest thing. A lot of people, when we look at a truck, just look at that truck. You're thinking too much. Do you see what I'm saying? Which is good, but because you know there's another piece. But what I'm trying to do is help you understand the differences between these various accounts. Okay? Awesome, guys. Okay. So, we're back to these, users of financial information. Oh my gosh. Why do they want all this stuff? Well, the way in which we communicate it is through these financial statements. Some people write drafts and reports and they explain their processes. Not accountants. Accountants take all these transactions or economic events that have happened and we record them into financial statements. The financial statements show us the income statement, which is the difference between the revenues minus the expenses and the net income. The retained earnings statement, which we'll talk about in a minute. The balance sheet, and the statement of cash flows. These are the 4 financial statements we're going to talk about in this class. Okay? We're going to go into detail on each one of them. Here's our little review question. Net income will result during a time period when assets exceed liabilities, assets exceed revenues, expenses exceed revenues, revenues exceed expenses. You guys are making my job very easy. Here is an income statement. This income statement shows over a period of time the revenues that came in from a company, the expenses that went out by a company, and the difference. The key here I want you to pick up is an income statement is over a period of time. So for example, an income statement for the year ended December 31st, 2014 is not just what happened on December 31st, 2014. It's January 1st through December 31st. It covers a period. Sometimes it can cover a week, a month, a quarter. But the income statement shows the operations or the results of the revenues and expenses over a period of time. So if you get a question from me that says, which of the financial statements covers information over a period of time, what are you going to write? So after we have recorded our revenues and our expenses, we come up with either a net income or a net loss. Now this net income or net loss then flows to another statement. It flows to the retained earnings statement. Do you see here? They're all going to be linked. And I'm showing you the income statement is the very first statement we will prepare. After we prepare that, we flow that information of the net income or the net loss into the retained earnings section. What happens is retained earnings is a list of all the profits and all the losses minus any dividends that have been paid throughout the entire time of existence. So once we have that net income or net loss determined, we're going to take that figure and flow it over into the retained earnings section. And in this case, let's say the company's brand new. If we started the period with 0, we're going to then add our net income, okay, to the business, to the retained earnings section. And as you can see here, if we pay out dividends, because those dividends come from a portion of our profits, of our retained earnings, we're going to have to subtract those dividends from our net income to come up with an ending balance. Hang in there with me because I'm just in the middle of something, but it'll all flow together here. Know that net income ultimately flows into the retained earnings section. Now, this retained earnings section shows the changes that happen during the period, what it starts the period with, what it adds to the period, and what it subtracts from the period. So this basically shows you why there were changes to the retained earnings section during the period. The balance will always continue. So the balance starts from the previous period. And the net income gets added to our retained earnings. But if we pay out dividends, they get subtracted from our retained earnings to come up with an ending balance. Now, remember, you start with the income statement. Then you work on the retained earnings section. Then we end up with a balance sheet. Now, the balance sheet, as you can see, has a portion of the information from the retained earnings carried over into the stockholders' equity section. Do you see that there? So do you see how the financial statements flow into each other? The net income from the income statement flows to the retained earnings statement, then flows to a section in the balance sheet that is listed as retained earnings there. Okay? Make sense? Now, a balance sheet. This is really important. You'll see it again and again and again and again. This balance sheet is a snapshot. I like to look at the income statement as over a period of time, not the balance sheet. The balance sheet is a snapshot, like a picture taken at one point in time. Usually the point in time is at the end of the period or the end of the year. The balance sheet shows all of our assets up at the top here. You see our assets? Total assets of $21,910. And then it shows all the liabilities we have plus our equity, stockholders' equity. And the liabilities and stockholders' equity equal $21,910. So do you see here how assets equal the liabilities plus the owner's equity? Does that make sense? That is the most important equation you will learn in accounting. It's called the accounting equation. You'll see this again. Assets equal liabilities plus owner's equity.